It's my pleasure to welcome Adam Phillips of EP Wealth Advisors, where he is the Director of Portfolio Investments, oversees direction for the firm. He's an expert in all things markets. We'll talk the stock market, bond market, the imminent interest rate cut, gold, Bitcoin. Here we go.
There is maybe something, to be said about this taco trade and the fact that we know that if things get bad enough, President Trump might change his tune on some things and come to the rescue. We saw it in April. And so maybe that is one of the reasons that when we have seen little bouts of volatility, they haven't really lasted too long. Now, I will say it gets harder to justify the higher the market goes, right? It seems like you're just opening yourself up to potential disappointment. We're not going to rely solely on that. And that's why we are neutral across our portfolios. We're not going to step on the gas pedal here.
Let me stop you right there for a second. Let's get into the overnight. The interest rate on the long end basically hit 5% overnight. And the headlines were the court stepped in on the tariffs, introducing uncertainty. But what do you think is going on there? Because logic says to me, to date, companies have been sucking up most of the tariffs or passing it off to distributors, but it hasn't hit the public yet. But is it just reintroducing uncertainty that spiked the long end, or what do you think?
I think that's part of it. I think there's so many drivers here, but one of them is that if you do bring in this additional uncertainty and the possibility of these tariffs going away, then you're losing a potential revenue generator for the government. And that's something that was accounting for, call it a quarter of our deficit.
Scott Beth, wait, a quarter of our annual deficit, right?
That's correct. Yeah. So
let me just stop you there for a second to pose a question, if I may.
Sure.
So we lose that revenue, quarter the annual deficit. Okay. But any economist is going to look at things and say revenue coming in on one side versus consumer spending declines or other negative impact. It's hard for me to fathom that, you get all the gold on one side from the tariff, but no reduction in anything else, no negatives. What do you think?
I think that's right. Look, I think that we can look at the possibility of tariffs going away as a potential positive for the economy, certainly for the consumer. We do view them as a tax. The question is who's being taxed. I think that's kind of a lingering question. But I think what it all comes back to is the fact that our deficits aren't going away. And in the meantime, we're losing a couple key buyers of our debt. Number one is the Federal Reserve. They're not buying bonds anymore. And the second one is obviously foreign investors. About 25% of our government debt is owned outside the U.S. And that number is falling. It's going in the wrong direction. And so as we think about these ongoing deficits and the fact that almost half of our outstanding debt is actually coming due in the next couple of years, there's a whole lot of supply that's going to flood the market. And we're wondering if there's enough demand out there to satisfy it. And that big question is what is putting upward pressure on long-term yields.
All right. So there's the 30-year. At the same time, the Fed, let's take Fed member Waller, for example, right? There's pressure to cut rates, political pressure, obviously, but you even have Waller suggesting that the ADP data, even into August, the labor data is weakening. So Fed cuts rates because things are bad or to avoid things getting worse or becoming bad. Yet, on the other hand, we're saying things are great. So that would be an inflation spike. And there have been tax increases vis-a-vis tariff so far that the market assumes businesses are paying. So businesses have accepted essentially a higher tax rate, right? Lower profits and tariffs going to the government. So how do you balance, cutting the short-term rate to stimulate and a 10 and a 30-year that, aren't coming down, let's say?
Well, we're getting different messages here. And that's the big issue, right, is that President Trump is talking about the fact that the economy is in really, really good shape. But at the same time, he's putting a lot of pressure on the Federal Reserve and Chairman Powell to cut rates. And so those two don't actually align. Those contradict each other. And so, look, I think that the economy is softening. The risk of recession is quite low. We're seeing weakness in the labor market, but inflation is still an issue. And so that is how you can see the short-term bond yields actually move lower in anticipation of lower rates. But at the same time, you see the long end move higher in expectation that the Fed Maybe they're being pressured to do it or maybe not, but the Fed is prioritizing economic growth over inflation, over that other side of their mandate. And because of that, you see inflation expectations moving higher. And that is the big one. That's why I don't envy the Fed's position at all, the position that Jay Powell is in. But I think that Chris Waller was out there today talking about how we should see numerous cuts beyond just September. And I think that we are still in a highly uncertain environment where, yeah, it looks like the September cut is a done deal, but that doesn't suggest that this is the beginning of a rate cutting cycle. I think that we still do not have enough clarity on inflation and whether it will be as short-lived as many hope and many, such as Chris Waller, expect it to be.
All right. So with that, we have gold essentially at new all-time highs. So gold is traditionally a safe haven. Yep. An inflation hedge as the dollar falls, which it has over the last year, and which it should with, quote, falling interest rates. Right, so dollar down, gold should be up a bit. But all-time highs?
I think gold is moving higher for a few reasons. Number one, many view it as an inflation hedge. I think history is mixed there, but let's assume for now that it is a good inflation hedge. That is one driver. We certainly know that there's a whole lot of geopolitical risk out there as well, and it's historically a good hedge against geopolitical risk. We saw what's been going on in China over the last couple of days as they're hosting leaders from India and Russia, North Korea. I think the third driver here is demand from foreign central banks. And what I saw data last week that actually showed that the foreign central bank holdings, actually about 30% of foreign central bank holdings are actually in gold. And that's the first time since 1996 there's more in gold among their holdings than treasuries. Treasuries are about 25%. Gold is at 30%. That is a huge reversal. And I think a lot of this is because they just don't want to be as dependent on the dollar or US assets as they used to be. They know that we can weaponize it. They've seen what we've done with Russia and sanctions. And so I think that they're looking to diversify. And that's just another catalyst.
So if I hear what you're saying, if gold is replacing the dollar for these reasons, then it suggests that interest rates ought to continue to move up if foreign central banks, et cetera, aren't buying U.S. debt issuance.
That is the concern. That's why within our portfolios, we're focused on the shorter end of the curve. And I think that a lot of retail investors don't generally buy 20, 30-year debt anyway. But it's certainly, one of the reasons that we're not about to start. And we want to be very careful and positioned for the possibility that rates could go higher here.
And I want to talk about California munis and real estate in a little bit. But before we get there, the Goldilocks case would be you can cut the front end of the curve. Fed can lower rates. Inflation is tame. So we can lower rates, stimulate growth, and that essentially the philosophy is that rates where they are now at the short end, mortgages and the like, are too high and it's choking off growth. So Goldilocks is we can cut them and get things liquid and moving forward. All right, so let's assume that's true, just for argument's sake. And at the same time, the long end is moving higher, the reasons we discussed. So we've got a steeper curve and more risk in the system, geopolitical, all the other elements. Okay, let's say that happens. Stock market's at all-time highs as well. Are things priced to perfection?
I think that we're in a situation where we are vulnerable to downside surprises and disappointment. I think another way of saying that is that, at least over the short term here, we are priced for perfection. And we're banking on a lot of things going right. One of them being earnings continuing to accelerate and outperform expectations. The other one is inflation returning back to 2% or something that is represents a healthier rate of price growth. So I think that any disappointment to disrupt that narrative would not be a good setup for equities, especially at current valuations.
So we didn't start off by going through your background, but you're a CFA, correct? And you also work in alternative investments, some private public markets, across the spectrum. Can you tell me a bit about your background? And I know you've been there for quite a while.
Absolutely. So I oversee investments for EP Wealth Advisors. We are a registered investment advisor headquartered out of Torrance, California. We actually celebrated our 25th anniversary last year. And so we've been around for quite some time. And really our mantra here is focusing on one client at a time. And I think that approach and focus on the individual client is really what's allowed us to grow and to now manage roughly 36 billion and have 50 offices across the country, and over 500 employees. So I've been here since 2014, so just over 11 years now. And I've been fortunate to be a part of a lot of this exciting growth and expansion of our investment offering, expansion of our services. So we are a planning-based firm, and what that means is that we offer comprehensive wealth planning, whether it's financial planning, tax planning, estate planning. We do subscribe to that belief that the financial plan is what you can control. I need to put my ego and pride aside and say that it's not about investments. It's about planning first and using the financial plan to identify a plan, a long-term plan for your assets to make sure that your goals are realized. And that helps to inform which investment strategy me and my team then deploy. So we do not lead with shiny objects. There's certainly a lot of exciting stuff that comes across my desk in the investment landscape, and things continue to evolve. But we need to be very, very selective and make sure that when we build out our investment offering, it's always done with the client in mind and to satisfy a specific need for the client. And I think that's really, really important. My role, I have about 35 people on the team here in the investment side, and it's really focused on the non-negotiables are you have to have a really solid research process, and you have to focus on execution. That's how you take care of clients when it comes down to investments. It's not about leading with these shiny objects. It really is just as simple as focusing on that solid process and looking after your clients.
Let me ask you, you're based in Southern California.
Mm-hmm.
Real estate or the single family home, would you say that in your typical client's portfolio, and I'm talking California client, that their home is in their top 3 assets, or where would you place it?
Absolutely. We know what real estate values are like here locally and in the Los Angeles area and in Southern California, and it is certainly a large part of our local clients' total net worth. It's one of their biggest assets, if not their biggest. And so we need to treat clients that are here locally a little bit differently than clients that are located in other areas in the country where property values aren't quite as high. And that can translate to different portfolios or different strategies. You mentioned our use of alternative investments. That's just a way to provide for enhanced risk-adjusted returns for clients, but they're not right for everybody. And we can talk about why that is. Just to take that one step further, a lot of times when we're talking about alternative investments, specifically real estate for clients, a lot of times we're not talking about it for clients that already have a good portion of their net worth tied up in hard assets.
So let's talk back to interest rates for a second. So let's stick with Goldilocks and the short end of the curve that influences mortgages, or the middle of the curve, let's say. Let's say mortgages are down a point over the next 6 to 12 months. Right? So now we're going to go from, 6 3/4 to, let's say, 5.5. Does that change your client's life? Do they refi? Obviously, there's a big percentage that are locked in at under 3 or less than that, so there'll be no refi. So put those aside. But for everyone else, let's say they're carrying a $2 or $3 million mortgage. I don't know what your typical would be. On a $2 million mortgage, a point reduction is about $1,000 a month, roughly. All right. Does it matter? Does it change consumption patterns?
Not necessarily for our clients, right? Where if we're focused on high net worth clients, then that may have what we call lower marginal propensity to consume. If they have more savings, they're less inclined to go out and use that to spend. I think it would move the needle more for those in say, the lower income tiers or those with lower net worths. We've talked in this environment over the last couple of years about this K-shaped economy, the haves and the have-nots. It's really those lower income households that are feeling the pain a lot more than those at the higher end. And so if we do see 100 basis points off the mortgage, the mortgage rate, I think that would be certainly welcome. I would imagine that many of our clients who are in existing mortgages, they would go and refinance. Whether it would change their lives or their budgets, I don't think so. I do think, again, it would be meaningful from just the broader economic standpoint because it would, I think, stimulate the housing demand and it would obviously improve affordability. I think it would also allow those that are in adjustable rate mortgages. It's only, I believe it's less than 10% of outstanding mortgages, but it would certainly provide
Sure.
some relief there, as well as those with credit card balances, specifically those in lower income tiers. It would bring their rates down a little bit. So I think that lower rates ultimately would be a good thing, but wouldn't move the needle quite as much for our clients.
It doesn't hurt. I mean, we used to use the term pushing on a string, and I wonder if, I don't know, the average home in California, let's use Southern California, entry-level homes are $1 million. So, for folks there, 1 million, 2 million, whatever the numbers, or greater propensity to consume, the change matters. I just think that, maybe we're not going to get the push out of it that we would hope. Something doesn't add up for me where we sit, like I say, stocks at all-time high, gold at an all-time high.
Yeah.
Wealth disparity wider, as you said, the K-shape than it's ever been. I just wonder if we're missing something.
Well, look, I mean, I think one of the reasons that we are more cautious here over the near term and we have a neutral equity allocation across our strategies and don't want to lean in too heavily in terms of adding risk to portfolios right now is that several months ago, let's say at the end of March or at the beginning of the year, who would have thought the market would be at all-time highs when we're living in an environment where we're actually seeing the housing as soft as it is. On a national level, we're looking at home prices that are down 4 months and 4 months straight. On a year-over-year basis, still up about 2% if you look at just the broad index, but weak housing and an environment where we're seeing a challenge to the Fed's independence and all this tariff uncertainty. So, yeah, I mean, I have a hard time squaring everything that's going on right now with a market that's at all-time highs. And I compare this to my kids and their selective hearing, and I think that we all will take the data that we get, and it's kind of the market is in itself a Rorschach test where we all have different interpretations of the data. But for us, we're very mindful of how much risk we're taking on in client portfolios and looking at high valuations and all the uncertainty that's still out there. We're very, very cautious here.
Putting pure politics aside, there is more risk in the system. And to restate what you just said, it may not be priced in. Although if you believe in efficient markets, everything is priced in. So at least in the longer run, 6 months isn't the short run. So we've had some time. So you'd have to argue that, much of it is priced in. But things are changing. I mean, Google today, or whatever they call themselves now, Alphabet, so they don't have to be broken up. So antitrust, shall we say, is a little bit less of a worry for business at this point.
Yeah.
Yet the U.S. government took a 10% or is taking a 10% stake in Intel. I mean, that doesn't square to me with the free markets. I mean, if you think back to 2008 and bailing people out and, GM and all the other stuff, I mean, at least half the country was adamantly opposed to it. And now that same half is buying into Intel or supporting the purchase of Intel.
Right.
So things just don't add up for me.
Well, and I think what's so difficult is that it's the challenging of these historical norms, whether it's challenging the Fed's independence or taking stakes in these public companies and saying that there's potentially more down the road. One that's being floated is Lockheed and taking a stake in a company that we rely on so heavily for defense. And yeah, I think that this is it's a big question mark, and this is the Intel example and Lockheed. They've been referred to as down payments towards our sovereign wealth fund, which we don't have. And I think most don't think we really need one. I think other companies that are reliant on commodity exports and where demand might fluctuate from time to time, they need to kind of have that nest egg to smooth things out during tough times. That's never been the case with us. So, you wonder, is this just another way to hopefully pay down our debt over time? I don't know, but to your point, Tom, this is something that I think a lot of us have trouble just really understanding, and there's a lot of change that's being thrown at us very, very quickly. And so we're trying to roll with the punches here. And as I said, in a way that many investors are turning a blind eye, at least for now, and hoping for the best. And sure, we could point to a lot of positives. And I can spin a positive story here. Absolutely.
Sure.
I do have a we do believe the bull market is intact. That doesn't mean that we can continue on this uptrend that we've seen. Where I mentioned we're at all-time highs, the market, the S&P 500 is up about 30% since the low on April 8th. And it's basically gone in a straight line. And so when we're talking to clients, it's really about managing those expectations and saying, look, it's been a very smooth ride here over the last few months. I don't know that we have any more uncertainty than we had, back at the lows. One can argue we have less certainty than we did before. And so
let's just stop there for a second. 30% in 3 months. Is that right?
Yeah.
4 months.
That's right. That's right. Yep. So it's, look, and if you actually track that, you see that any dips that we've had along the way since April, they've been few and far between, but they've also been they've been, in terms of magnitude, they've been very, very modest, a couple percent here, and it lasts a couple days, right? And so I think that that's really important to highlight. So, I in a way, I credit retail investors because it appears that a lot of this demand is actually being seen on the retail side, where we're seeing individual investors come in and buy. And that's great because I always preach to clients and say, look, you invest for the long term. You want to be greedy when others are fearful. And so we're seeing that. You also want to make sure that it's not swinging too far that way and people aren't becoming complacent, because you always want to be mindful these things can change very, very quickly. I think we got a taste of that in early April. And we're just in an environment where things are very, very fluid and we can be surprised very quickly.
So let's stay on technology money moves more quickly now, right? There are other forms of money. We used to talk about non-bank financial intermediaries, which essentially meant, a bank that could perform services without the full charter. So that's the predecessor to, I'm going to say, digital assets. So what's your view? I mean, obviously, there are tremendous benefits to using the blockchain for, put your mortgage on the blockchain, put your piece of artwork on the blockchain. You're no longer worried about provenance and these sorts of things. It makes perfect sense. That's progress. So now we've got, I'm going to call it a digital asset, and Digital Gold was a great early book on the subject. So Bitcoin, let's just stick with that for a minute. Is there anything there?
Yeah, look, I think that there very well could be. Bitcoin is a very, very tough one. And so we find ourselves talking about it more with clients. Obviously, everyone wants to know about it when it's doing very well, and you don't hear so much when it's really struggling. And so this is one of those times when it's done very well. It's been on quite a run here, and so we've seen what the catalysts are. We're seeing broader institutional adoption. We're certainly seeing an administration in the White House that is very supportive of crypto in general and these alternative forms of payment. So yeah, I think that there is potential here. What I struggle with is, this is not something that it is easy to assign intrinsic value to. It doesn't provide earnings. It doesn't provide cash flow. And so for us, it's very, very hard to value and look at it. If it's trading at, if it's worth one Bitcoin is $115,000 per take, what does that mean? Is it cheap in the grand scheme of things? Is it expensive? It's very hard to know. And I think that is one of the reasons that it is as volatile as it is. So when clients ask us, should Bitcoin be in a portfolio, we say it can be, but within reason. And this is highly speculative. And so we generally tell them they should cap it to just a small percentage of their overall wealth, just because it is so volatile.
All right. So let's take gold. So gold isn't really used for much anymore, but it's been accepted as a store of value and really a means of barter, global. All right, so let's accept that as true. The US dollar or any currency is backed by really the nation's financial system, the nation's wealth, theoretically. US is not going to default, hopefully, and therefore people are willing to accept it as a medium of exchange and a store of value. So Bitcoin, there's no one behind it. There's nothing behind it. But if you want to make a bull case, what you say is the governments that will or do own it, black rocks or black stones that will stand behind their piece. Okay. But do you then end up with a system of, it's a decentralized currency, right? That's the whole idea. It's decentralized. So do you have fiefdoms around the world, each sharing a global currency? I'm not saying that's good or bad, But it's hard for me to look at it another way.
I think you're right, Tom. We've seen institutional adoption, and you mentioned the BlackRocks of the world wanting to get in on the action. So, I focus more on the technology. As you said, blockchain is very, very interesting. Stable coins, I think, are interesting because they can be that medium of exchange. They can be a lot easier to use for processing transactions, for moving money. It could be less expensive as far as the fees that are associated with it compared to traditional credit cards. And so I think that there is something to be said for stable coins. Things like Bitcoin, it's still challenging, and one of the things I struggle with is the fact that what makes it so attractive is that it's not regulated. But I think that that's also a potential weakness, because I think generally what we see is that governments like the US, they want control over it. They want to be able to tax on these transactions. They want to understand and make sure they know what it's being used on. Is it being used for fraudulent activity or in the black market for different things? I think that is one of the risks here, and why decentralization isn't all positive, and it could actually be a risk.
Do you see a much different investment approach or view towards the markets now, generationally, your older clients and your younger clients?
Yeah, I do, and I think it's a reflection of the exposure that many younger investors have. They have exposure, I think, to alternative investments. I mean, if we think back several years, most individual clients didn't have access to things like alternative investments, and since a lot of newer investors came of age, that these are now available to everyone, and so it's kind of they're democratized. And
so, give me three that are interesting to you when you said, just so we're clear on what an alt is.
Yeah, so yeah, great question. Alternative investments, sometimes clients ask, and I just say, look, it tells you more about what something is not than what it is. And it's not stocks, it's not bonds. And the idea is that you use them because they can behave independently of what the stock and bond market are doing. The idea is that they should be able to provide that diversification benefit and overall better risk-adjusted returns over time. And so when we talk about alternatives, the three that we find ourselves talking about, I'd say most often these days is private equity, private credit, and private real estate. And you can throw in private infrastructure as well. But these just offer additional opportunities for investors. And it's not to say that they're
pooled assets.
Say that again, Tom.
As pooled assets. So you would buy
Yes.
into a pool of infrastructure or a pool of whatever.
That's correct. That we generally prefer to invest in these more diversified investments rather than specific projects themselves.
And do they tend to be backed by the Blackstones of the world, or who are the big names in these projects?
Yeah, so Blackstone, certainly Blue Owl is big, specifically in private credit. The KKRs, the Carlyles, there's a number of the big names here, and sometimes big is good, and it gives you that sense of comfort that a larger firm is managing this strategy or sponsoring it, but doesn't necessarily mean that you only want to stick with the big ones, right? Sometimes size can actually hurt you and mean that you might look past an opportunity because it's too small for your portfolio, your strategy you're running. It's just not going to move the needle. And so because of that, we also look at smaller managers that have really strong teams and processes, and we want to give those a fair shot as well. But it's a really interesting landscape. We've been investing in alternative investments for a few years, and this is something that you really want to make sure that you have a very thorough research process and a team that's really digging in there, because manager selection is so critical when you get into alternative investments. And these, because these tend to be less liquid, you can't take a mulligan, right? And if you change your mind, you can't just back out like you can,
Sure.
like you can sell a stock the next day.
Are the fees you charge under pressure? Are they lower than they were 5 years ago, 10 years ago?
No. We've actually held our fees steady, and what we've continued to do is it's really important to make sure that you're delivering an adequate service and justifying your fee, right? And so as I said earlier, I need to understand that it's not all about investments. I think it's really important to do your job well in investments and have a very strong research process and focus on good execution. But it's about so much more than that. And there are other ways to deliver value to clients. And so we've been focusing on building out our offerings to continue to meet the evolving needs of clients. And so examples of that are, it's really moved away from traditional financial planning and expanded into areas like estate planning and tax planning, real estate analysis. There are many other types of services across our offering that we offer clients.
I think what you just described is what's happening to the residential real estate industry. A year back, there was a change in rules such that fee payment changes, right? Mm-hmm. Each side pays their own, right? All right, big deal. But it is a big deal. But the point I'm driving at is, I don't think the typical residential realtor, manager, even owner, understands that the pressure to fees here is just what your industry went through over the last 25 years. 25 cents a share to, in many cases, zero or a flat fee, and that's coming here. So I will have to justify my value just as you have to justify yours. And there is a differentiation between the E-Trades or the Schwabs of the world and the RIA or the professional like yourself. Same thing on my end. It's influenced by technology and all the other things we've talked about today. I think you can point very directly.
Absolutely. And look, as I mentioned, last year was our 25-year anniversary as a firm. And this, because it's on us to continue to justify our fees to clients. We can't rest on our laurels. We've had a very good 25 years, but we need to continue to expand our service offering and find new ways
your money.
To serve our clients. That's right.
Yeah, and that's stand proud and that's what we do.
Yeah, absolutely.
So anything that you'd like to talk about that we haven't hit on, anything interesting to you as you look at the financial news or, Southern California, anything stand out?
Right now, what I'm really focused on is what's going on at the Fed, right? And challenges to Fed independence. We got the employment report coming out on Friday. We know that we are currently going without a head of the Bureau of Labor Statistics. And so we'll see what that report looks like. We haven't seen President Trump's nominee confirmed just yet. And so there's questions right now about data integrity. I don't think there's anything nefarious going on, but I think there's certainly, we've seen response rates falling with these job numbers over the last several years, and other surveys, other types of economic surveys as well. So it's nothing new. But I think it's going to make our job a little bit trickier. And so we're looking at a whole a variety of data to get a good read on the economy. And so this all is going to set us up for FOMC meeting, which is next week, which we are highly anticipating. We do expect the Fed to cut. And it'll also be this, once a quarter, we get the new summary of economic projections. And so we'll get the latest read on where those within the Fed expect policy rates to end the year for this year and next year and the following year, which isn't quite as helpful, but it'll be helpful for this the end of 25, the end of 26, and then we'll get their reads on on the forecast for where the unemployment rate is going, where inflation is going. For us, we are still, something we talked about earlier, is that we see confirmation across a number of data sets that suggest the labor market is not as strong as it was. A good example is today we got the job openings and labor turnover survey, JOLTS data. It showed that there's less than one job opening available for every unemployed worker. And that's the lowest in several years. And you can rewind the clock a few years when the job market was quite a bit healthier. There were 2 job openings for every unemployed worker. So things have changed very, very quickly. So we know things are weak there, but we also know inflation is not yet defeated. And so, the Fed is in a pickle here. And just because they're expected to cut rates in September doesn't mean that we're going to get that additional cuts beyond September are guaranteed. And so we expect this debate over the future of monetary policy and pressure from within the administration to continue. And this is really important because it does inform inflation expectations. It could move the stock market. It could move the dollar and obviously long-term bond yields. And so this is, I think this has broad implications for where things are going. And so that's why we're focused on it. And we we don't want to see anyone mess with Fed independence, and so we along with everyone else, are on high alert for any changes there. So I'd say that's what I'm focused on right now.
Interesting. So Fed independence, the firing at the Bureau of Labor Statistics, purchase of a piece of intel, sounds to me like we're directly targeting a bedrock thought process of full faith and credit of the U.S. government. I hope I'm wrong.
Yeah, look, absolutely. And let's not forget, with the news that came out on Friday with the court ruling against President Trump and his use of IEPA, the emergency powers to enact those tariffs, they are going to remain in place at least through October 14th, give some time for this appeal to go through. One of the big questions is, okay, are these going to be refunded? I don't think that that's a high probability event, but if they did have to be refunded, we've collected over $200 billion in tariffs. And so if that was refunded, it would put a hole back into our fiscal plans and our deficit and put upward pressure on yields. But I think beyond that, just talking about challenging the norms here, if President Trump's appeal was not successful, then we could see him actually use other powers that are afforded to him through the Trade Act of 1974, sections 122 and 301. It really just gives the president a discretion to enact tariffs and really unilaterally. And so I think tariffs are going to be here to stay one way or another. The question will be, where does it all land? This has been months of headlines without much progress or much detail. And so I think that's what we're all kind of waiting to see. And second to that is, who's going to pay for it? And for our money, we still think it's going to be on the consumers, but we're waiting to see it.
I agree. My bet is, even with a loss, they aren't refunded, but they are offered in the form of tax credits over future years. That's my guess. I do agree it's a tax, and I also think it will be passed on to the consumer. It's just a question of when, but maybe I'm wrong. So thank you very, very much.
Great. Thank you.